China set a new record in the first quarter of 2024 by selling an unprecedented amount of U.S. government bonds, according to data from the U.S. Treasury. This move is seen by many economists as part of a deliberate strategy to reduce reliance on dollar-denominated assets. In the initial 3 months of 2024, China offloaded $53.3 billion in U.S. Treasuries and agency bonds. This activity coincides with China's significant increase in purchasing gold and other commodities, reflecting a broader effort to diversify its holdings amid escalating geopolitical tensions with the United States. Analysts suggest that China's actions are influenced by observing the economic fallout from sanctions imposed on Russia following its 2022 invasion of Ukraine, aiming to shield itself from similar vulnerabilities. Craig Shapiro, a macro advisor at Larduk Trading, highlighted 3 main reasons for China's shift. The management of Russian reserves by the US and other G7 countries, including threats of expropriations and sanctions, likely motivated China to cut its exposure to US Treasury assets to avoid similar repercussions, he explained to Newsweek. He also pointed out the implications of rising US fiscal deficits. China likely expects US interest rates to climb further due to ongoing fiscal deficits, making it sensible to sell now to avoid potential losses or repayments in devalued dollars, he added. This strategy could help China stabilize its domestic economy without risking the yuan's devaluation. This week, U.S. Federal Reserve Chair Jay Powell indicated that the federal funds interest rate, currently at 5.25 to 5.50% since last July, is expected to remain unchanged for a longer period due to persistent inflation. Brad Setzer, an economist at the Council on Foreign Relations, offered a contrasting view in a late 2023 article. He asserted that the proportion of US dollars in China's reserves has remained stable since 2015. He presented evidence that the dollar share in China's reserves had stayed consistent between $1.80 and $1.9 trillion when adjusted for treasuries held by offshore custodians like Belgium's Euroclear. As we continue, please support us by clicking on the subscription button and turn on the notification bell for more updates. China's diversification efforts also extend to raw materials, particularly crude oil. In 2023, China maintained its position as the largest importer of crude oil, purchasing a record 11.3 million barrels per day, up 10% from 2022. This increase was driven by a surge in fuel demand following the lifting of pandemic restrictions. Some economists speculate that China's aggressive commodity purchases might indicate a strategic devaluation of its currency, the yuan. Such a move would make Chinese exports cheaper and more competitive globally, a desirable outcome for China's leadership amid a manufacturing surplus and low consumer confidence. However, devaluation poses significant risks, including higher import costs, increased inflation, potential instability in global currency markets, and the threat of trade wars as countries react to the influx of cheaper Chinese goods. This scenario is often referred to by economists as a nuclear option. Devaluing the yuan could have wide-reaching consequences, both domestically and internationally. For China, a weaker yuan would lead to higher import costs, which could stoke inflation within the country. This inflationary pressure could reduce consumers' purchasing power and exacerbate existing economic challenges. Internationally, a devalued yuan might destabilize global currency markets. Other countries might feel compelled to devalue their currencies in response, triggering a potential currency war. Such competitive devaluations can lead to increased volatility in foreign exchange markets, creating uncertainties for international trade and investment. Moreover, cheaper Chinese goods flooding global markets could provoke trade disputes. Countries affected by a surge in inexpensive imports may implement protective measures, such as tariffs or quotas, to shield their domestic industries. These actions could escalate into broader trade wars, disrupting global supply chains and slowing economic growth worldwide. Despite these risks, China's leadership might consider currency devaluation as a means to bolster its export-driven economy, especially in the face of slowing domestic growth and diminishing consumer confidence. However, this approach must be carefully weighed against the potential for inflationary pressures and international economic instability. In conclusion, China's record sale of U.S. government bonds and increased commodity purchases highlight its strategic efforts to diversify away from dollar assets and mitigate geopolitical risks. While these moves aim to strengthen China's economic resilience, they also carry significant risks that could impact both China and the global economy. As China navigates these complex dynamics, its economic policies will be closely watched by economists and policymakers worldwide. Thanks for watching. Let us know your thoughts in the comment section below.